G'day everyone and welcome back to another live stream with the Aussie Investing Machine. Thank you all so much for joining me. Great to have you here. In today's episode, we'll have a look at some of the latest results. It is reporting season after all, and we've seen a number of companies report their latest results. We'll have a look at some of those. We'll check out these two companies which I've featured on the thumbnail, JBH Hi-Fi and Breville. Have a quick look at those guys. They've had some pretty interesting results. I also want to take a quick look at Redbubble as well. We've seen a massive drop in Redbubble share price, so we'll take a look at that company. As always, if you've got any questions, please drop a comment in the comment section and I'll do my best to get to all of them and answer them as best as I can. So without further ado, I think maybe we might start off talking about Redbubble. Some big news today. We've seen the company actually report some really good results in terms of revenue, but the market didn't like it, so the share price has gone down quite a bit. Let's jump over to that. I'll just get my screen shared. Alrighty. Hopefully you can see me there. Cool. So having a look at Redbubble, we can see trading at $6. Not too long ago, they were up at $7. So it's not a crazy crash, but it's enough, to really bring some value off the stock. Mind you, in November they were at $4. So we've seen the stock lift, and maybe it's correcting, but really the news that we're looking for is over here at the Motley Fool article. Leading broker says Redbubble share price sell-off is a buying opportunity. Crashed 18% today to $5.60. Looks like it's gone up, back up to $6 by the end of the day. So why did the price drop so much? That's the question. Well, the company reported a 96% increase in revenue. So that's awesome. 100% up. In terms of revenue is better than what you could expect from any company, and 118% lift in gross profit to 144 million. So they've come out of loss into profit, yet they've been beaten down by 18%. So Goldman Sachs commented, Redbubble released its first half 21 result, which beat our forecasts but missed on costs. So the broker notes that gross margins fell from 43 down to 38, whereas customer acquisition costs rose from 10% to 14%. So whilst the company had some good growth on paper, what Goldman Sachs is highlighting is that it's become more expensive for the company to generate that growth than it was in the past. And this obviously affects how quickly the company can scale. And what this indicates is that the bigger Redbubble gets, the more expensive it is to acquire new customers. So that's a problem because it puts a cap on their growth, essentially. And that's why the stock price is adjusted to account for this, essentially. So is it a buying opportunity? Goldman was disappointed. It sees the weaknesses in the Redbubble share price as a buying opportunity. Whilst it's disappointing, our investment thesis remains unchanged. It's got a large global addressable market. E-commerce trends have been supportive of online demand. They've got a strong balance sheet, plenty of cash. So their consensus is that it's still worth investing in, and it's attractive relative to its peer group. So I did a little bit of research on this. We can see their price to sales, it's really low at like 3.9. So in terms of value compared to Afterpay, compared to Tesla, compared to any of these companies, it's great value. Potentially doesn't have the momentum or potential revenue or growth possibilities that those companies have, but it is very cheap compared to those guys. As a result, Goldman Sachs has put a buy rating of 715. So it's trading below the Goldman Sachs price target. So it could be a good time to invest if you are interested in Redbubble. I haven't done a video dedicated to this company. If you'd like to see that, let me know, and I'm happy to put one together. yeah, drop a comment and let me know your thoughts. I'll just check out if we've got any comments. Not just yet. We'll keep going. So I'll come over to my presentation for this live stream. Just the two companies to talk about this week, which are companies that have recently reported. JB Hi-Fi is the first one. So we know JB has had a ripper 2020. They did super well during the pandemic. I think if we have a look at their share price to see what happened at the start of the pandemic, we can see that if we go 1 year. So in March, they got smacked pretty bad. They lost. So they were sort of around $50. Pandemic hit, down to 45. So got knocked, but then I think people quickly realized, with people working at home and all of the accessories required to do that, and people being at home for longer, so everything became in need of upgrading because they were utilizing it more. TV, computer screen, appliances even. JB sells all of it, so they quickly recovered and hit here we are. So down to 24, so half of what they are now, in the midst of the pandemic, from a previous top of about 40. So really got smashed, but then quickly bounced back, and to levels they are now. And if we look at their earnings, some of the numbers are incredible. So online sales up 162%, which is huge. Net profit jumped more than 86% compared to the previous 6 months. So people are still spending so much money on consumer electronics. It's incredible. Online sales were strong. In Australia versus New Zealand, that is. So total Australia, New Zealand was 162. Australia only was 202. But this was only 15% of the total sales. So their competition against Kogan and similar companies like Catch.com and MyDeal, which is an ASX listed company, JB is still predominantly relying on in-store sales. Customers still like to visit physical stores, and I know personally I like to go to JB Hi-Fi stores even when I don't want to buy anything. I think they're just great to look in. They've got everything on display, so much range, and I think that's their strong suit compared to a company like Kogan. I still like Kogan, and I think, I hold them in my portfolio. But Kogan's online experience is very good. It's better than JB's, in my opinion. So JB has a lot of room to grow in that space, I think. And because it's a trusted retail brand, I think that 15% could easily increase quite rapidly without detracting from their physical sales. The other component to this is they bought out the Good Guys a couple of years ago, which was a competitor and is now part of the brand. Harvey Norman competes more closely with the Good Guys. They both focus a lot on appliances. JB does have the JB Hi-Fi home stores, which sell washing machines and fridges, but it's not their primary focus. And now that they've purchased the Good Guys, I can't see that being, why would you want to be in competition with yourself? The Good Guys booked a 26% rise in total sales as well, which is respectable. It's not as much as JB, but it's still very good. And I think it's obvious that the total demand for home appliances and consumer electronics is just off the charts. And we know part of that is working from home, but it's been sustained up until now. And it goes as far as that we're actually finding there's shortages of these products in stores. And that might be because global supply has been affected whilst the demand's lifted. So we've got, reduction in available stock. But it is still really incredible that the demand is still so strong. It'd be great if you guys had any insight on why you think that might be the case. We know why it was earlier in 2020, but the fact that demand is continuing now, is it government stimulus? What do you think it is? I'd love to know your thoughts. Drop a comment and let me know. And the other factor for JB is that they've substantially reduced debt over the past 12 months. Now, this was a statement in an article I read, but I thought it would be interesting to just dive into that. So I did hear to see if that was true or not. And this is the statistics from Self Wealth, my online broker, and it shows you the 2020 column. So this may not be the latest, but we can see their trends up to 2020. Certainly doesn't look like they were paying down debt. Current liabilities were up massively. Long-term debt was up marginally, and total debt was up, a fair chunk. Might be worth going to, perhaps if I go to their market index page, we'll get a snapshot of the very latest results. We'll see what they are. This is a quick way you can check if you've ever got to verify information or have a look for yourself. Market index always has the latest announcements. Here they are, filed today at 8:30. Open this up and we should get a pretty clear picture. Get through all the guff. So there's the sales. You can see that, that's fine. Divisional performance. It's interesting. Won't get stuck on that though. We're looking for the full results, including the debt showing year on year. So it's all still profits, revenue, good guys separated performance. Here we go. So the balance sheet for the entire group, JB and the good guys. We're looking under liabilities, looking under borrowings. So in half year 20, they borrowed a bit. Yeah, so at the start of half year 20, they were at $1 billion of borrowings or liabilities. They reduced that again halfway through 2020, and now it's come down marginally. So yes, it's coming down, but I wouldn't say significantly. Total current liabilities are higher than, well, that's non-current. Total liabilities actually really have gone up, but that may be to purchase stock because of increased demand. So if we look at the non-current, which is your typical long-term borrowings like your debt, then yes, it's gone down, but that's a bit of a wish-washy statement. To buy inventory. So that's, it's not a super impressive metric. I don't think JB paying down their debt doesn't seem to be that impressive. The dividend though has been strong. You can see this interim dividend, massive. It's going to be a huge dividend result. And if we look at their dividend history on market index, we can see this dividend aristocrat forming really. And that's for 2021, that's only the first dividend that's been paid. So it's looking to become a very nice dividend stock at this rate. Look at this beautifully increasing dividend. So we'll see how they go. I'd like to hear your thoughts. ASX Analytics, thanks for joining, mate. Good to see you on the stream. Agree, retailers look good as long as the spending spree continues. Yeah, 100%. Yeah, okay, well, that's a fair point. You make the point that overseas traveling, or the lack thereof, has left people with more money, which they're spending on consumer goods. Yeah, that's a great point, because we're seeing JobKeeper, JobSeeker dry up, but at the same time, it's not that big of a deal because people spend thousands of dollars on flights and accommodation for overseas holidays. And at the moment, even if you go for a domestic holiday, it's not nearly as expensive as it may be on an overseas trip. So that's where this excess cash is coming. I like that analysis. Great comment. And yeah, excited to see how you go on Saturday on the big live stream for ASX Investor. I'll see you there. But yeah, good luck with that. I'll be on a bit later. So yeah, good to see you. Thanks for the comment. I might move on to Breville Group. We'll just jump over back to the presentation. So that's JB. We'll call that a wrap. Onto Breville. So another really interesting company that I haven't covered in depth. So Breville actually dropped its dividend by 30%. And they said they did this to capitalize on growth opportunities. And this was despite the company's net profit going up by 30%, which is a significant increase. You wouldn't think that with an increase in profits, which typically you'd pay out, that you'd drop your dividend. So Breville Group paid out 81% of its profits as dividends. So its payout ratio is quite high, not as high as a lot of the banks, but still up there. And that might have been a reason why they put the brakes on the dividend. Breville Group paid out 54% of its free cash flow, which is not a bad amount. It means they still had plenty of cash left over in order to fund other operations. But yeah, it's limiting the earnings that they can reinvest. So if we look at Breville's, for example, if we go to Breville on Market Index and we look at their dividend track record, we can see it's also very strong, or was trending that way. It's been increasing since 2009 year on year. So they've had a 10-year streak of increasing dividends. And this is just their interim for 2021, but they've got a big gap to close if they want to continue this trend. I think, look, here they've missed one, maybe two. But overall, the trend has been impressive. They're targeting themselves towards dividend investors by producing this dividend, but we're starting to see that the payout ratio is starting to get a bit tight, and they've really lowballed investors on this first interim dividend this year. So it'll be interesting to see what they do in the second half of the year, whether they decide to pay out more and jump the dividend so that it continues their strong track record and appeal to dividend investors. Obviously, if we see a massive drop off in the dividend, this stock will go out the window for a lot of people who are focused on dividend investing. You can see the payout ratio is 114%. I'm not sure where it's drawing that data from. But yeah, from my research, I got the figure of 84. So now, any other items here worth speaking about? I don't think so. I'll just jump back to the presentation. So that was about the free cash flow. And it's rare to find a company that's grown its dividends rapidly over 10 years. We just saw that they've done that, only missing about 2 years where it was flat. Breville Group's done that. And similar to JB Hi-Fi, the company's struggling to secure enough stock to meet demand. So we know that they've got a lot of demand for their products. They're selling a lot. We can see their profits up 30%, yet they're not paying out the dividend. It's a bit weird. It's sort of as if they're anticipating a withdrawal in demand. The retail segment's interesting at the moment. I feel like a lot of stocks might be a little bit overpriced. If we look at something like Temple and Webster, that got Temple and Webster, it got bashed a little bit when vaccine news came out and things started to open up, but it's started to recover. You can see on the 1 year chart, it was really boosting towards the back half of 2020. And then lockdown ended and things started opening up and it got hit hard, and it's just been bobbling around since then. But prior to that, the straight run up was glorious. It was a really good run for the company. They looked unbeatable, and now it's been a bit stagnant. So I'm not sure when their results come out. That's probably one to check, unless they already have. So first half 2021 has come out, and the next one's not till August, so it's worth having a look at this. Okay, Temple and Webster, 118% revenue growth, EBITDA, massive growth, plenty of cash on hand. Looks pretty glorious. However, when I did my stock scan, in my last live stream on Monday, it didn't appear in the results, and I'm curious to see why that is. Perhaps their debt levels are quite high. It's worth having a look at. If we get into the details, let's have a look here. And if they reveal them, maybe this is the presentation, is it? Yeah, we want this one, half year results. So, looking for the debt figure, I've no doubt that earnings per share went up 15%. Where are they? It's not giving us much in depth. That's annoying. Okay. We know that's up 118. Half year results, we looked at that. The presentation didn't give us much. Interesting. It's only 3 pages long. The investor presentation didn't have much for us. If anyone knows where we can find more detailed results for Temple & Webster, definitely let me know. Because this just isn't enough, really. So revenue, costs, okay. I wonder if in self-wealth we can have a look. Temple & Webster, have a look at their financials, balance sheet. So debt is low, debt to equity will be fine. So it is a little surprising that they didn't appear in my stock scan. EPS is definitely there. The market cap, definitely over 300 mil, I would have thought. Yeah, 1.3 billion. Interesting. There must have been something else that knocked them out of the equation. Very, very interesting. All right, guys. I think that might do us for tonight. It's been a bit of a quiet live stream, but I appreciate all of you who joined us. It's always good to have a chat with you. If you've got any questions watching this live stream back on replay, absolutely drop them in the comments and I'll be sure to answer your questions. Yeah, let me know. I've got another live stream on Saturday with the ASX investor. We're doing that over on his channel, so make sure you tune in for that. Otherwise, yeah, I might wrap it up here. Just a quick one tonight. Again, thank you so much for joining me, everyone who did tune in, and I'll catch you in the next one. Thanks very much, guys, and I'll see you soon. Bye.